All right, let's dive in. Today, we're talking about a company whose story, based on my own research, the market is getting fundamentally wrong. That company is Crocs. Now, on the surface, their recent numbers look, well, incredibly confusing. And you know what? That confusion is exactly where the opportunity is hiding.
Okay, so here's the disconnect that really got my attention. You've got this scary headline number screaming a loss of over $8 per share. But then, in the same breath, the company talks about a healthy adjusted profit of over $4 per share. So, what's the real story here? Which number actually shows what's going on with the business?
This massive confusion has created what I believe is a significant opportunity. It's a classic case of the market panicking over a misleading headline while completely ignoring the company's true financial strength. And that, right there, is why I see this as a deep value play. To really understand why, we have to solve the mystery behind that huge reported loss. And it all comes down to a single, very large accounting item that's throwing everything off.
The entire loss, every penny of it, is because of something called a non-cash impairment charge. The best way to think about this is that it's purely an accounting move. It's like the Zillow estimate on your house goes down. It's a loss on paper, but no actual cash ever left your wallet. It's not a real cash loss.
And the size of this paper loss was just staggering. Almost $740 million written down against the value of its Hey Dude brand. Now, while it follows the accounting rules, a charge this big completely warps the picture of the company's actual real-world profitability. And here is why that distortion is so important. While the accountants were booking that huge paper loss, the business was actually a cash-generating machine, cranking out nearly $770 million in free cash flow. This is the crucial point right here. The cash flow, the lifeblood of any business, is incredibly strong. It tells a completely different and much better story than that scary headline. And that powerful cash generation, that's just the start. It's the first of three pillars that form my buy thesis for the company. Three big reasons why this stock is so compelling, especially with all the negative noise out there. My entire bull case really rests on these three core ideas. First, as we've already seen, it's an undervalued cash flow powerhouse. Second, the original Crocs brand is still incredibly resilient, and it's growing. And third, you've got a proactive management team that's very friendly to its shareholders. And this table just perfectly illustrates the valuation gap. I mean, when you ignore the accounting noise and look at what really matters, sales and cash flow, Crocs is trading at a massive discount to its peers. The market is valuing $1 of Crocs cash flow at just under 6 times. Compare that to 18 for Deckers or almost 31 times for Nike. That's a huge difference.
Now, the second pillar is just the raw, enduring strength of that core Crocs brand. Yeah, North America has been a little sluggish, but the brand is absolutely on fire internationally, posting over 18% growth. This global appeal proves this is not just some domestic fad, it's got real staying power. And this isn't happening by accident. The company has a brilliant marketing playbook. They do these high-profile collaborations, they have a dominant social media game, and they're crushing it on platforms like TikTok. They've managed to keep the brand incredibly relevant and desirable, especially with younger consumers.
The third pillar is management's really disciplined financial strategy. They are taking that powerful cash flow and using it to create value for shareholders. Just last quarter, they paid down over $100 million in debt and bought back $133 million of their own stock. And get this, they still have over $1 billion left to buy back even more. And you know, talk is cheap, but nothing shows confidence like the company's own leaders buying stock with their own money. The CFO and a board director both made significant purchases on the open market just last month. That is a powerful signal that they believe their stock is a bargain right now. Of course, no investment is a sure thing, so a balanced analysis means we have to look at the challenges. And in the case of Crocs, my research pointed to 2 significant headwinds we need to be aware of.
So these risks really boil down to 2 things. First, the ongoing turnaround of the Hey Dude brand, which, you'll remember, is the source of that big accounting charge. And second, just the broader economic pressures that are hitting pretty much all consumer companies right now.
The biggest operational challenge is definitely Hey Dude. While their direct sales to consumers are actually growing, sales to their wholesale partners, think shoe stores and retail chains, fell by a steep 13%. Management is working on fixing this, but for now, it's a major drag on the company's overall performance. And externally, yeah, the company is facing a tough environment. They've guided for a pretty sharp revenue decline in the third quarter, and they're blaming two things: consumers tightening their belts and the financial hit from trade tariffs. These are very real headwinds.
So, after weighing all those powerful strengths against these very real risks, what's the final verdict for my report? Where does the balance ultimately lie? Okay, so the bottom line is this: that reported loss is an accounting issue, not a cash flow problem. This company is a cash machine, trading at a discount with a strong core brand and a smart management team. The market seems to be way too focused on punishing the stock for the Hey turnaround, which I actually see as not just a risk, but the biggest potential catalyst for the future. So for all these reasons, my final recommendation is a buy. I've given it a medium confidence level because that Hey turnaround and the tough economy do create some uncertainty. But I fully expect this thesis to play out over the next 12 to 24 months as the company's true cash-generating power becomes impossible to ignore. And this really leaves us with one final thought. When the market gets fixated on a negative headline, it often misses the deeper story. So the question for you is, what is the market seeing or failing to see here? For my money, it's ignoring a long-term cash flow machine that's just hiding there in plain sight.